Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey, all right. Welcome to the Financial Purpose Podcast. This is episode 45. And today I'm going to talk about investing in real estate. Now, I have a handful of conversations about this topic every year with a handful of clients every year. And it's a great conversation because investing in real estate can be a really great way to diversify your financial assets, to generate some income, but there's a lot of things that go into the decision that I think kind of get missed. So some people get kind of sucked into thinking about real estate investing through, books like Rich Dad, Poor Dad by Robert Kiyosaki, or, some other like ways that you can generate passive income per se. And then some people get suckered in by how easy it is. And usually that's going to be, something that they see on social media, or they have a friend who has a rental property, or, maybe during the pandemic bought a property. And so they now do Airbnb or short-term rentals. And so I want to give you, if you're considering investing in real estate, or if you're already starting, I want to give you some things to think about as far as, number one, when it makes sense to consider real estate as an investment. Number two, when it doesn't make sense for you at this time or at any time to invest in real estate. And then I want to talk a little bit about the differences between long-term rentals and short-term rentals, because there's a big debate over which one in the long run makes the most sense, or maybe has the higher profit. So we're going to talk about those things. Where these conversations typically come up for me is, especially in the current environment, where I'll have a client who's looking at either upsizing or downsizing their home, and when they're looking at the new house that they're going to buy, they have a decision of whether or not they want to keep the current house. And so that current home, they think maybe they'll just hold it for rental. They have enough equity where, they have some room. Their mortgage payments are lower because they have a lower interest rate. And the current rental market, especially here in Arizona, you may be able to get a higher rental amount where you can make a little bit of money. So that typically is where the conversation comes up. Very, very rarely does it start with somebody who has excess capital that they don't know what to do with, and so they're just going to dump it into real estate. That's not very commonly what I hear. So again, we're just going to talk about what makes sense. So the very first thing, when it makes sense to invest in real estate, the first thing you want is to have a stable financial situation. And you want to be able to properly assess where you are financially. Before you dive in, you want to have a good foundation. Sometimes real estate can require a lot of upfront capital to manage and pay for ongoing expenses. And so you want to make sure that you have enough savings, you have good credits, and you want to manage your debt load. So your balance sheet personally needs to be fairly healthy. And the next thing you want to think about is how long you want to hold real estate. So anytime that you're investing in real estate, it is a long-term, for the most part, it's a long-term strategy. Now, you may be the kind of person where you're thinking that you can flip homes so you can buy distressed properties, put a little bit of money into them, flip them. And in the current real estate market across the country, now may not be the best time for that type of strategy, but it could be depending on where you live. So the thing about real estate is it's not universally applicable. Property values are not the same across the board for the same size homes or the same style homes or the same size lots. So depending on where you live, that would be a consideration. But real estate, because of the nature of the asset, it appreciates over time. It's probably best suited for somebody who wants to hold a couple of properties for a number of years, maybe longer than 10 years, maybe shorter than 10 years, again, depending on your goals. But it allows you, the longer you hold it, you benefit from the appreciation of the price of the property or the value of the property, but you also collect a higher amount of rents over that period of time. And for some people, that increases your rate of return, or your return on the investment, which we'll talk about a little bit later as well. For some people, investing in real estate is because they want to have some diversification. As I said, different than stocks and bonds and other types of investments, real estate gives you another asset in another asset class that generates value and appreciation and income on its own. So the beauty of having that diversification is it does spread your total investment risk across a whole bunch of different asset types, which have their own volatility ratings and their own market cycles and things like that. And so it can actually give you some buffer depending on what's happening in the economy. For some people, it's another way to have a steady, potentially steady cash flow on the side. Now, when you're investing in real estate, that's typically considered passive income. I've been around it long enough to know that there's probably not a whole lot that's really passive about it, because typically if you own one or two investment properties, you're probably going to be involved with things like collecting rents and making sure that everything's in working order and hiring the repair person or doing the repairs yourself when something goes wrong. But generally, you're involved in the management of that property. Now, once you get a portfolio of properties, now maybe it makes sense to hire a property manager and things like that, or a full-time or even a part-time handyman or something like that. But typically, good cash flow potential is possible. You can have another stream of income. It can enhance some financial stability for you, just to have a couple extra. Maybe it's a couple $100,000. Maybe a couple $100 a month coming in. Maybe a couple $1,000 a month coming in, depending on the size of your portfolio. And then, of course, you can scale this to have multi-family housing, which is where that can really grow quickly, especially if you get to duplexes and then into 10 units and then into 24 units and then into 200 units and on and on and on. There's actually a really good, if you're reading about real estate and people who have been successful, another name that gets mentioned often is Grant Cardone, and he lists this strategy out both in his books 10X and also Be Obsessed or Be Average. You might check those out, and he'll walk you through how he developed his real estate strategy. But most of that's in 10X, and it's all in just him writing down his goals and continuing to 10X those goals. And so maybe that's for you. For other people, it's an opportunity to have a little bit of leverage in your portfolio, because when you borrow money for purchasing a property, you're using somebody else's capital at a percentage of interest, which allows you to generate a return on that money. And so leverage can actually be a way to increase the ROI, but it also increases your risk. So that could be something that you want to consider as well. And then there's some tax benefits that are available for real estate and for depreciation and for the cost of managing the property and things like that. So you can get some tax diversification as well on your income, and as far as what you're able to deduct and to claim as good solid deductions. Now, when real estate might not be the best option, the list kind of looks the same, but we're going to flip it on its head. And so in this case, real estate may not be a good option for you if you have limited liquidity. And that's because you might need to have quick access to capital if something goes wrong with the property, or if you don't have enough money saved up to do things like repair a roof after storm damage, or if the HVAC system goes out, or if there's a water leak and you need to get somebody in there right away, and then you have to do some remodeling and you're waiting on the insurance claim, but you have a tenant in the house, and so you need to have a little bit of float available for yourself if you're going to be a landlord, or if you're going to own multiple properties. You need some liquidity. If you don't have liquidity, you probably ought to pause and save up some money and figure out what that looks like for you. You also have to consider that you may have high entry and maintenance costs because you're going to have down payment to get into the home. For a lot of real estate investment properties, you're going to have lower loan to value limits from your lenders if you're going to borrow money. And so you need to plan for that. You're going to have closing costs. You're going to have maintenance, maybe property management cost. Older homes, if you're buying an older home and you're thinking you can rehab it, often you can buy those at a lower price, but they're typically going to come with a higher cost to maybe bring it up to code or to make it attractive with great, countertops and cabinets and shelvings and, fixtures and toilets and showers and tile and things like that, carpet and whatever it is. It may cost you more in the aggregate to buy the older home and then do all the remodeling. At the same time, if you buy a newer home, it's going to cost you more upfront because the newer home's going to have a higher price tag, but you're going to have a lot of deferred or delayed maintenance cost. And so you'll want to consider what that might look like comparatively over a 10-year period as far as what those costs are going to be. And you need to know that before you go in based on the type of home that you have and what you may need to be considering with just the surrounding properties and drainage and trees and all that kind of stuff. The next thing is you may have, as with any investment, market volatility and risk. Real estate is, of course, especially volatile during economic downturns. You can have periods of vacancy where you're not able to rent the home, which means that if it's leveraged, you're making the mortgage payment on the rental home. You're probably going to be making a mortgage payment on your own home, and so you're going to have double the cash flow drain there. So you'll have to understand that. You can have problematic tenants who either don't pay or they slow pay or they're destructive to the home, or you may have to at some point evict a bad tenant. And so there's going to be court cost and lost time and lost rent wages or rental income, I should say, and then all the repair cost if somebody does, trash your house. So you definitely want to think about that. There's a lot of time and effort that's required, again, especially if you're dealing with a small portfolio. You probably are the manager. And so what's your time worth? How much repair are you going to do? Do you have a tenant who is prone to breaking things? Do you have a tenant who is handy enough to help fix things? And so then you can negotiate rent discounts and things like that. But it's still going to be time and effort that you're going to have to manage and plan for. Also with real estate, it can increase your concentration of risk because it's very, very easy to buy a property or two or three, and then suddenly a large chunk of your net worth is tied up in real estate. And so we would consider that high concentration. And so when you have high concentration, that can increase your total risk to your net worth, to your liquidity, to your financial well-being. And so also another way that you can concentrate your risk is if you have a lot of the same kind of property. So if you have 3 single-family units in the same neighborhood, you could have some challenges there. So you want to think about where are the homes that you're considering investing in or the commercial property. What is the neighborhood like? How far away are your properties from each other? Are they different types of properties? Are they too far away for you to manage effectively if you need to, say, for some reason have to visit all 3 in the same day or even the same week? Do you have the ability to do that? So that there's a lot of concentration related issues there that you want to think through. And then finally, real estate requires some good knowledge of the market in your area, of property managers who are good. There's a lot of people who throw up a property management shingle, but may not actually be that helpful. So you want to know how to evaluate the best property manager for you. You're going to need to have a really good real estate professional and a really good lending professional on your team. And so that requires a lot of searching and knowing exactly what you're looking for, what type of work those professionals do, what's their approach, what's their expertise in the market, because they certainly can be very helpful in steering you down the right paths to make a good investment decision in real estate. So with those two, when it is a good option, when it's not a good option for you, if you decide that it's a good option for you based on what I just discussed, then the next thing that you want to look at is, do you want to hold a long-term rental or do you want to hold a short-term rental? And I'm not talking about the length of time that you own it, but I'm talking about the length of time that you rented it in a given period of time. So long-term rentals, pros and cons real quick. Pros are you typically have a predictable cash flow. That can be considered stable income because typically you're going to have a 1-year lease. You know what that fixed payment is going to be for a year. You should have a pretty good idea of what your fixed costs are over that same year period. So you're going to have some pretty stable, hopefully, profit there. So you know what your numbers are. Not a lot of risk there unless you end up with somebody who has to leave within that year's time. They're breaking a lease. They're going to pay a penalty for that, or you're going to keep their deposit, or however you negotiate that. But for the most part, that 1-year term is going to be very helpful. Typically, because of the 1-year nature, you're going to have lower turnover rates. So hopefully you have a tenant who stays for a year, and if they stay for a year, maybe they stay for 2, and if they stay for 2, they get comfortable. Maybe they stay for 4 or 5 or whatever. If it's the right tenant, then that's a great scenario because then you know what you're working with. But low turnover can be very helpful for you as the property owner. When you have a long-term rental and there's less changes in your tenants, you tend to have lower management cost and management issues because typically you know the people, you know their stability of payment. You're probably not worried about having to deal with court cost or evictions or chasing down, payments every month or things like that. Your expenses should be fairly predictable. Once in a while things happen, but the longer you have the same tenant in the property, the more that they're going to be in tune with what's happening on the property. And so you'll get a lot of heads up. You can manage how they're maintaining things like changing air filters. As an example, right? That's one way to preserve, especially here in the desert, that's one way to preserve your air conditioners, to make sure that your tenant's changing the air filters once per month. So just little things like that you'll be able to get some control around. And then again, long-term rental agreements tend to be a bit more thorough and comprehensive in nature, and so you'll have some protection for yourself as the owner of the property should something go wrong with the tenant. And typically the tenant will have some protections as well in that agreement as a long-term tenant. And so you will have duties that you will owe each other as, the lessor and the lessee. And then you'll have protections from each other if there's violations of those agreements. So some of the cons of holding real estate as a long-term rental is you typically will have lower income potential because once you set the monthly rate, that's what it is for the next year. And often if you do increase the rent, you have to increase that in small percentages because otherwise you're likely to lose really good tenants if you try to just come in and jack up the rent. So typically the income potential is going to be a bit lower there. You do have the risk of problematic tenants. As I said earlier, you have some limited flexibility on how you're going to use the property or how soon you can turn over the property because it may not always be in your control as far as when somebody is going to move in or move out, especially on the move out phase because you'll need to honor that contract or you'll have to break it and pay them. And then there's potentially some legal blowback there, but also you have limited flexibility on whether or not you can sell it and how you can sell it because a new buyer may want to keep the tenant in place and they may change the rent structure, or they may not want a tenant. They may want to completely start over. They may want to make changes to the home, that kind of thing. So it does limit your flexibility. And then especially coming out of the pandemic, there's a lot of regulatory challenges to some of the protections that landlords have had in the past with things like eviction notices and how long they have to give notice of non-payments or partial payment and things like that. And so states have made rent protection a bit more how should I say this? Maybe more complex to follow or more complex to enforce in some cases, again, depending on the type of property that you own and where that is located. So you just need to make sure that you're aware of what the real estate laws, and especially the rental real estate laws, are in your municipality and in your state, just to make sure that you're able to comply with those regulations. So that's long-term rentals. Short-term rentals, some pros here are you do have higher income potential because you're able to charge higher rates based on demand and based on seasonability, based on weekly rates, nightly rates. Somebody wants to stay there for 2 weeks, so you can play around with what that rate's going to be, and you can take it off availability, which means you can pull it down for the weekend. You and your family can go stay there, and then you put it right back on the market, and then people can rent it again. So just a lot more flexibility, and a lot more higher income potential. You'll have frequent tenant screening, so you'll be able to get better at managing who's coming into your home and how that's impacting the neighborhood, which I'll talk about here in a few minutes. And then there's also some decent tax deductions that you can pick up because of the costs that you're going to put in for things like frequent cleaning, updates. You're going to buy certain type of furniture for the home to make it attractive for somebody who's coming in just for the weekend or for the week, based on where that property is located. Is it a ski lodge? Is it a beach access home? Is it a hunting property? Whatever the property is, you're going to have some variance in how you decorate that. And so every time that you make a change there, or you pay someone to clean it, or you have an upgrade or a maintenance issue, those are all potential tax benefits that you can pursue. Now, some cons with short-term rentals is it does require more management effort, because you have to be on top of when the property is rented, when it's not, getting the property ready for the next guest, cleaning up after guest, making sure that there aren't things that you don't know about happening in the house, making sure that there aren't holes in the walls that you don't know about. And so the inspection time, the cleaning time, the turnover time, that's all baked in there. And again, that time and that effort has value that you need to make sure that you're aware of, and you're pricing accordingly. You could have some seasonal and some market fluctuations. So for short-term rentals, there are certain places where certain times of the year people don't want to go. Maybe that's right here in the desert. Right now in June, it's relatively hot, and it will be hot through probably September or October. And so you may not get people who are coming to Scottsdale, Arizona for a June wedding. We may not have June brides. No June brides means no June bachelor or bachelorette parties, which means that you may not have a lot of people there. We also don't have, this time of year, we don't have a lot of sports happening. We don't have a lot of events, so there's not a lot of people coming into town. That may be the same for you on a different part of the country where winter is where nobody travels to your town. Maybe you're in a town where people come in for the summer because of the beautiful weather or lake access, and maybe they come for the fall because of apple picking and cherry festivals and things like that. So you just want to be aware of the seasonality, and then of course market fluctuations. During economic difficulties, people are not going to spend money on travel and lodging as much as they would when things are kind of a little bit more loose and everybody feels good about the economy. So you'll want to be aware of that. Of course, higher frequency turnover, number of people coming in close proximity just means higher wear and tear. And it's going to be on things like rugs and towels and carpets and, hardwood floors and dishes and things like that are high use. Bed sheets and comforters and couches, right? All of that stuff, you just have a higher potential for a higher wear and tear cost. Also, one of the things that you want to think about, this could be one of those hidden costs, is insurance. And the insurance rates on short-term rentals are increasing because of the liability factor. And so, higher damage rates means higher claims means higher premiums. And so short-term guests can be, they can be messy, and they can be careless because it's not their things. They might treat it like a hotel room or worse. And so that can be, from an insurance standpoint, expensive. From a liability standpoint, you know, there are all kinds of things. We did a short-term rental a couple years ago with our family in Big Bear, California, and they had an issue where somebody jumped off the balcony into their hot tub, trying to do a cannonball into the hot tub, broke the hot tub, and so they had some liability issues there. And so people just do dumb things when they're on vacation, and they think that there's no consequences, and they break your things or they break themselves, and either way, you're liable. So you have to be aware of that. And then also here, for short term, definitely regulatory challenges, because there are certain municipalities in this country that do not allow short-term rentals, period. And so some communities, some HOAs are pushing back against short-term rentals, and oftentimes it's because of noise violations and increased traffic, housing availability and affordability. So short-term rentals can pull entire neighborhoods off the market for people who are looking for housing to buy or to rent. And so that can cause a lot of problems for a locality, a local municipality. Locality, what is this, like Beverly Hillbillies or something? Anyway, whatever, you get the gist. It can be a problem, and so you just want to know all those things before you decide on which way you want to go. So once you have decided that you're going to go down the road of real estate, you're trying to choose between short-term or long-term, and you're considering all the things I just talked about, the next thing that you want to do is understand how you calculate the profit from your rental property, because your numbers need to be part of your decision. And certain properties are going to have a better net operating income and profit ability than other properties are, and you want to be able to evaluate that smartly. So there's several key steps. You want to start by determining what you can rent the home for, and so that's going to be typically over a period, probably a year. So ideally, you're going to have a year-long contract. Either it's with a long-term rental, or you want to factor in how many times you can turn over a short-term rental at what price. And so you want to know what your total income is going to be for the year, and then you want to factor in all of your expenses and subtract those out. That's going to include property management fees. It's going to include maintenance and repairs. It's going to include property taxes, insurance, any utilities that you're going to pay, and then you probably also want to put in a vacancy factor in there, and you can talk to your realtor about what the local vacancy factor appropriately is going to be. But in general, for some places, it may be anywhere from 2 to 3%, 5%, maybe 8%. Anything with a higher vacancy rate than that, you're going to typically start to see the prices go down a little bit, because that looks like a riskier property, and so you want to be aware of that as the buyer. You may not want to pay full price if there's a high vacancy rate, unless you can improve the vacancy rate by putting some money into the property. So that all has to be part of your consideration. The next is that you're going to account for things like mortgage interest, and I just said the vacancy. And then once you get down to whatever that final amount is, that's going to be your net operating income, or abbreviated as NOI. And you'll find your profit by subtracting any non-operating expenses. That's going to be things like capital expenditures or improvements. So capital is going to be things that improve the structure, roofs, walls, mechanical, water, things like that. Once you get all of that, you're going to have a clear picture of what that profitability is. And then the other way that you can evaluate this, I talked about ROI. You can set a target ROI. Now, typically ROI is best measured once you've sold the property. Then you can see what your return is, because you'd have real numbers to work with. But just like any other investment, you want to have a target rate of return, or return on your investment. And so basically what you're going to do there is you're going to compare the cash that you earned, or the cash that's returned, based on the amount that you invested. And so the formula is very simple there. You can take your net profit, which is going to be adding up all of the things that I just said, right? All of your rent receipts minus all of your costs. That's going to be your net. divided by the total amount of cash that you put into the property as an investment cost. And then what you're going to have there is your percentage of rate of return or return on the investment. And the higher the percentage there, naturally, the better, but it potentially also means higher risk. And so again, you're going to have a higher ROI potentially on a short-term rental than you will on a long-term rental, but you also have more risk on a short-term rental than you do on the long-term. And so a lower number, of course, on the opposite side of that is going to suggest a more stable, lower risk investment. So something to consider there. Another way you can look at it is by looking at the cap rate, and I would recommend knowing the cap rate of the property. It's a key metric that's used to evaluate the potential return of a rental property. And you simply do this by your cap rate is just simply your net operating income, which again I talked about earlier, which is once you take all of your rent receipts, subtract all of the things that we listed, and then you do a division there based on the property value. And so a little bit of a different calculation, net operating income divided by the property value. And that gives you a really good way to compare multiple properties together. And again, here, a higher number means more profit, but it also may introduce a little bit more risk, and you want to make sure you understand why. Lower number is going to be a little bit more stable, lower return, but it's probably going to be a more known and flexible, known, not that flexible because it's long-term and general, but it'll be consistent income, consistent cost. You'll be able to evaluate it that way. So as we kind of close this one up, basically, question is, should you, the listener, the watcher, invest in real estate? Maybe. Investing can be a very rewarding strategy, especially with real estate. As I said, it can generate additional income. It can diversify your assets. There's a lot of things that you need to know about your financial situation before you go in. It sounds great to just put a little bit of cash down and now you have yourself a rental property and you're off into the races, or again, to sell your current house, buy a new house, or hold the current house and buy a new house and try to rent that out. But you really have to understand what's most important for you, what's best for your financial situation. Run your numbers. Have somebody run your numbers. Hopefully you're working with a financial planner. Have them run your numbers and understand where you're going to be best suited. Should you have a long-term rental? Should you have a short-term rental? Should you do it at all? Should you wait for a period of time? Should you wait until market conditions move a certain way or the other? All of those things you're going to want to sit down and really evaluate so that way you can make a good, smart, sound investment decision. So if you have questions about real estate investing or if it's right for you, please send an email to info@lifemoveswealth.com or leave a comment on this episode, and we'll be happy to discuss anything that you're seeing, anything that you're curious about, questions that you have, how to calculate these things, what types of properties you can look for. I'd be happy to point you in the right direction. If you want to get an overview of where you stand financially, because remember, the very first thing I said at the start of this episode is you need to have a solid financial base foundation. So if you're not sure if you do, or if you want to get kind of a catch up on where you are, go over to lifemoveswealth.com/our approach and click on the Get Your Financial Health Scorecard button. That's going to lead you to a page where you'll be able to put in some information about yourself. It's going to show you an overview of your financial health. And once you do that, I'll get a notification. I'll reach out to you and explain to you what I see, and then we can continue the conversation from there. So be sure to also in the show notes, I'm going to put a checklist there for you, and it's entitled, What Issues Should I Consider When Owning a Rental Property? And that's a free guide that you can use. You can read all the information there, check off the boxes, make sure that it aligns with everything that I just said and then everything that's happening in your financial life, and that should be a really good resource for you just even to get started. So check the show notes, head over to lifemoveswealth.com or send an email to info@lifemoveswealth.com, and I will look forward to talking to you. I hope this has been helpful with whether or not you should invest in real estate. And until next time, go be financially awesome. Take care. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.